Very good evening, everyone. Tell me, is the video audio clear to everyone? Anyone, please? Is the audio and video clear to everyone? Yes? Okay. All right. Very good evening to you all. In yesterday's class, we learned about the basics of economics and the subject matter of economics. Today, as you have read in the thumbnail, our topic is utility analysis, production and wealth, or basically consumer behavior. So, moving ahead in the series of microeconomics, let's start with the types of goods. Now this is also very important. Although in yesterday's class I gave you a reference about the final goods, about the intermediate goods, but today we'll classify them and learn about them in detail. All right. So the heading is types of goods produced in an economy. Right. So the first category of goods which are produced in any economy is the category of final goods. As I have already discussed with you, what is a final good? Final good is a good which has crossed the boundary line of production, or in which there is no need of any kind of a value addition. What is value addition? Yesterday we have discussed about it in the earlier class, that production is nothing but the process of value addition, right? Do you remember? Production is nothing but the process of value addition. So production is the process when you add value to something or to a raw material. So it becomes a final product, right? So this is how final good is made. Final goods are goods which have crossed the boundary line of production and are ready for use by their final users. These are known as the final goods. Example, clothes, milk, right, which do not need any kind of further intervention in their to change their physical appearance or chemical appearance, right? So they are ready for the end use. Now there is no value addition required in such products. Is that clear to everyone? Okay. So they are called as final goods, and expenditure on these goods is referred to as final expenditure. Expenditure is the amount which you spend to buy something, some good or some services, right? So the expenditure we incur on the purchase of final goods is known as final expenditure, and the expenditure we incur on the purchase of intermediate goods which are not final goods is called as intermediate expenditure. Okay. Now final goods are also classified into two categories. Goods are classified into two categories, because we do not purchase only to consume, we also purchase to invest, we also purchase for our factories, we also buy something for our jobs, for our industries, right? So final consumer goods are those final goods which are purchased, which are bought with the purpose of consumption only. They are not deployed in any kind of an economic activity, right? These are the goods which are consumed by the consumers, like milk, bread, etc. Okay, are you getting my point? So final consumer goods, what are consumer goods? They are to be consumed. They are not used in the process of production. Okay, then final producer goods. Producer goods are the goods which help in the process of production, or they help in the process of economic activity, okay, or they are used for furthering a production activity or an economic activity. They are consumed or used by the producers. Now when we say that they are consumed or used by the producers, we obviously mean that the producers are using those goods for production, whichever good is being produced in their factories or industries. Okay. So final goods which are ready to use, no value addition required. There are two categories, the final consumer good and the final producer good. Okay. Now the next category is of intermediate goods. All those goods which are yet to be consumed, which require value addition. For example, let's take the example of steel. Okay, we do not buy steel bundles, okay, we buy steel utensils, right? So steel is bought by an industry for say machinery, so that steel becomes intermediate good for that particular industry, okay? So intermediate goods are those goods which are used for further value addition or for further production or economic activities, okay? As I discussed with you the example of wheat yesterday, that if a bakery, yes, it can also be called as capital good, no doubt, okay? Producer goods are capital goods as well, because the good which producer uses for any economic activity is a capital also, okay? Yes, so you can also call them capital goods or capital indeed, okay? So intermediate goods are the goods which are purchased by a firm for the use in production of other goods, or the purpose of reselling, alright? So intermediate goods have two purposes. Either you are using the intermediate goods for producing some another good, or you are using the intermediate good for reselling it. For example, if an industry X buys some bundles of steel for using it say for a production of any machinery, okay, so that steel would become an intermediate good. Another example, a milkman, say someone buys a milk seller, okay, so milk seller buys milk from somewhere and then he or she sells it to you. So the milk seller did not buy the milk pouches to consume or for his or her consumption or for consumption of their households, they bought it to resell it, right? So for the purpose of reselling also these goods are used, they are called intermediate goods. So either they are used for production of other goods or they are used for reselling. Alright, and the expenditure incurred on such goods or on intermediate goods is called intermediate expenditure. This is very simple, okay, basic concepts. Is that clear? Okay, moving ahead. The next category of goods which we have is consumer goods, okay, consumer goods. What are consumer goods? As the name suggests, consumer goods are the goods which are used for consumption purpose only, okay. So consumer goods which are directly used for satisfaction of human wants and which do not which are not used in production activity, okay, they are known as consumer goods. For example, ice cream, milk, etc. used by households, alright. So basically in economics, the name itself suggests you the answers, right? For example, producer good, good used by producer, consumer good, good used by consumer. So you need not get confused in the terminologies. The terminology will itself give you a hint regarding the content which it want to ask you, okay. So consumer goods are further classified into, now there are categories of consumer goods as well, right? As we also use these terminologies in our day-to-day life, that this particular good is a durable good, this is a semi-durable good, this is non-durable good, right? So the first category of a consumer good is durable good. What is a durable good? We all know about it, that durable goods are such goods which have a longer shelf life, okay, they can be used again and again. So when you use these goods again and again, they do not get exhausted, okay, they do not get exhausted. So durable goods are those goods which can be used several number of times for a long period of time. For example, your car, your air conditioner, right? First, when you buy a car, it is a long-term investment because it is a durable good. No matter how many times you use a car, the car does not get exhausted, although there is something called depreciation in its value, okay. With 5 years, 10 years of use, the value of the car, the value of the AC or any other durable good will decline, but that is something else, that is called depreciation. It will not get exhausted. Is that clear? Are you getting my point? Are you catching up? So these are durable goods. Then semi-durable goods. Semi-durable goods are those goods which do not have very long lifespan as compared to the durable goods, but you can use them repeatedly and they do not get exhausted with repeated use, right? They do not get exhausted in a single use, जैसे crockery, clothing, etc. ओके, क्रॉकरी हम लोग घर में यूज करते हैं, तो ऐसा नहीं है कि 2-3 बार ही यूज किया एंड देन कि वो टूट गया. अगर हम ध्यान से नहीं यूज करेंगे तो वो टूटेगा. बट क्रॉकरी हो गया एंड देन क्लोथिंग, ऑल दीज आर सेमी ड्यूरेबल गुड्स. देयर लाइफ स्पैन बेसिकली डिपेंड्स ऑन योर method of using them, your care which you provide to them. Okay, then non-durable goods. Non-durable goods have a very short lifespan and you cannot reuse them. Okay, short lifespan and they get exhausted in a single use. For example, you have a glass of milk or a packet of milk, you consume the milk, it gets exhausted. You have some vegetables, you consume the vegetables, they get exhausted. You cannot repeat or you cannot use them repeatedly. Okay, so these are non-durable goods. Then we have the category of services. As you all know that an economy produces goods and services both, right? Only goods are not produced. What are services? Services are like hospital services or medical services. Teaching is a service. Okay, software services. So there are a lot of services which are there. Okay, services are basically intangible items. Services are intangible items. Intangible means that you cannot touch a service. Okay, you can touch a doctor, but you cannot touch the service the doctor provides, right? So these are also called as intangible items which cannot be touched. Okay, so then comes the services which cannot be seen or touched, however it can be felt. You can feel the services but you cannot see the services flowing from somewhere to somewhere, or you cannot touch these services. Is that clear? Then we have the capital goods. Capital goods. So basically producer goods and capital goods can have a slight difference, although we can say that capital goods are also producer goods, but all producer goods cannot be capital goods. Capital goods are basically fixed assets. Okay, they are also called as fixed assets. They are used in further process of production. These goods are repeatedly used in further process of production. They are the fixed assets. Remember this. Okay, capital goods are fixed assets. For example, machinery. If someone or some industrialist who has established his or her industry buys some machinery for the process of production, so that machinery is a capital good and it is a fixed asset. It does not change. Once it is installed, it is installed. The industrialist or the producer would not change the machinery until some problem arises. Okay, right? So capital goods are fixed assets. Example, building, plant, machinery, right? They help in converting intermediate goods into final goods. This is also important. Intermediate good, raw material or any good which requires further value addition, right? When we try to convert intermediate good into a final good, then comes the role of capital goods. Suppose there is machinery which is being used to convert an intermediate good into a capital good, so that machinery is playing a role of capital good. This is very clear now. I hope so. Yes or no? Is that clear? Yes or no? Anyone? Alright, now comes a very important topic of microeconomics or consumer behavior, which is utility analysis. Okay, the concept of utility, wealth and production. We'll be dealing with these topics. So before moving ahead to the concept of utility, we need to understand what do we mean by a consumer, what is a consumer behavior, what is a consumer function, and how does demand or consumption of a particular good depends on several factors, right? So this is also an important topic for you. Who is a consumer? Are we all consumers or not? Yes or no? We all are consumers? Anyone? Yes? No? Yes. Okay, let me ask you one more question, although it is not related to today's topic, but still it is very commonsensical. Tell me, are we all taxpayers? Listen the question carefully and then tell me, are all of us present on the earth, I am including citizens of every country, okay, everyone living on this planet, is a taxpayer or not? Yes or no? Are we all taxpayers? Yes or no? No idea? Okay. Yes. Yes, indirect tax. Very good, Mitsuri. Very good. Yeah, so that's why I asked you that it is very commonsensical, okay? We all are taxpayers. I didn't ask you about whether we all are direct taxpayers. I asked you whether we all are taxpayers or not, right? So whatever we consume, whichever good we buy, be it consumer good, capital good, okay, producer good, we pay for it. The MRP. The MRP includes all the taxes, all the indirect taxes which were paid by the producer of that particular good during the process of production. So the MRP already includes all the taxes. So indirectly we are paying the indirect taxes. So we all are taxpayers, okay? Although we all are not direct taxpayers but indirect taxpayers. Yes, okay. So who is a consumer? Consumer is one who takes decisions about what to buy for the satisfaction of wants, both as an individual or as a member of household, right? You can consider a family, a household as a particular unit or as a consumer, or you can consider an individual as a consumer as well, right? So consumer is one who buys something, who consumes something for his or her own satisfaction. Simple definition of consumer. What is consumption? Consumption is defined as the satisfaction of human wants through use of goods and services. Why do we consume? We consume because we want to satisfy our needs. If we are hungry, we want to satisfy our hunger. If we are thirsty, we want to satisfy our thirst, right? So consumption is the satisfaction of human wants. Now there are several determinants. These can be asked in your examinations, that what are the factors which determine the level of consumption in an economy. Okay, I am talking about the aggregate consumption now, the consumption at the national level as a whole. So basically, or at an individual level as well, there are several factors which affect the consumption, which affect the demand or consumption by the households. So the determinants are, first of all, obviously price of the product, because as you know that the law of demand says if the price goes up of some product, okay, so quantity demanded will get reduced, right? So costlier the costlier the product, the less quantity demand it will have. So price of the product, then income available, of course. Your consumption, your expenditure depends on the income bracket you are in. Right? If you have more income, you are left with more disposable income, which is income which you can spend after paying your liabilities like taxes, like direct taxes, or any government liabilities which you have, or duties which you need to fulfill out of that income. Okay, so income available, then accumulated wealth. Yes, a person can have wealth as well. You have some inherited wealth or you have some accumulated wealth, so you can consume from spending out of that wealth as well, right? Then prices of other products. Now these other products are related products. What are related products? Related products are either substitute goods or complementary goods. Complementary goods. I am not going in detail of substitute and complementary goods in today's lecture, because we will be dealing with them in very detail with diagrams and charts in the chapter of demand and supply. Okay, so price of other products. For example, just for your understanding, I will give you a reference very fast, that tea and coffee. Tea and coffee are substitute goods, okay? Whether you prefer having tea or not, or coffee or not, does not matter. Let's consider that tea and coffee are substitute goods. So if the price of tea goes up, so the demand of coffee goes up. Why? Because tea has now become costlier, right? So if tea has become costlier, the consumer can easily switch to coffee because they are substitute goods. They can be used at each other's place. So this is how price of related goods as well impacts the consumption as well. Okay, then taste and preference. Yes, of course, a particular person, a particular household have certain has certain tastes, certain preferences, right? Some kind of clothes they want to wear, certain kinds of brand they want to have, right? So branded clothes, branded shoes, or non-branded clothes, non-branded shoes. Okay, Sarojini market, the clothes of Sarojini or the products of Sarojini. So you all have your income constraints, the price constraint, and then you have your choices. All right, then we have future speculations. For example, if you speculate that in future you will have a lot of income, so in present you will spend more. But if you speculate that your income will get reduced, or suppose you are planning for some huge investment, so you will not spend more at present, right? So your future planning or future speculation also affects your consumption. So these are certain determinants of consumption, whether the consumption is done by a household as a whole or an individual as a single entity. Is that clear? Price of the product, income available, accumulated wealth, price of the related products, and taste and preferences, then future speculations. Now there is another important concept known as consumption function. So although there are certain determinants, various determinants which affect the consumption in an economy, but according to Keynes, who is Keynes? J.M. Keynes. I have discussed it with you in the last class. Who is Keynes? Father of macroeconomics. Do you remember that? John Maynard Keynes, J.M. Keynes, father of macroeconomics. So there is a famous concept called Keynesian function or consumption function, because it was given by Keynes, so it is also known as Keynesian function. So according to Keynes, although there are several determinants which we have discussed, but according to Keynes function or Keynes consumption function, the consumption depends on A plus B by D. Now what is this equation? I'll explain it to you. So consumption function or Keynes consumption function is C, where C is overall consumption expenditure, which would depend on A, where A is autonomous expenditure. Okay, A is autonomous consumption or expenditure. Autonomous means that the consumption which does not depend on your level of income or your income, to say. Okay, for example, sometimes it happens that you get your salary credited into your account in the initial days of a month, but by the month end you get exhausted. Your salary gets exhausted, right? So but you didn't even then you do not stop spending on your consumption expenditure, or you do not stop doing your consumption expenditure. So that consumption expenditure which is not dependent on your income, because you have certain wealth, you have certain other sources to spend, right? Accumulated wealth, for example. So that is known as autonomous consumption. Plus B. B here is marginal propensity to consume. Marginal propensity to consume. I'll explain it. Then Y. This Y is disposable income. This Y is disposable income. What is disposable income? This Y is disposable income. YD. D stands for disposable. Okay. So capital Y, whenever you see capital Y in the economics, it is always income. Okay. Whether individual income or generally national income. Alright. Now we'll understand the consumption function. So YD here is disposable income. What is a disposable income? Disposable income means that the income which is now left with you for consumption or for expenditure purpose. Expenditure can be investment expenditure or consumption expenditure, but you can spend it at your own will. Okay. For example, if you are earning 60,000 per month, and just for an example, if you have to pay 10,000 of direct tax out of it or income tax out of it, okay, so you cannot spend 60,000. 60,000 is not your disposable income. After deducting the liability or your duty which you have to incur out of that income, for example in this case which is 10,000, so after deducting the 10,000 out of the 60,000, you are left with 50,000. So your disposable income is 50,000. Is that clear to everyone? Yes or no? This is disposable income. Okay, income after government intervention, that is benefits and taxes. When you pay your taxes and all out of your income, then you are left with the income which you can spend at your will. Then no one is going to ask you that, okay, you have to pay this amount to me. Alright, so this is disposable income. So why D here is disposable income, then B here is marginal propensity to consume. Now always remember, it will become easier for you that whenever you see this word marginal in your entire economics classes, marginal or any content or related to economics, obviously marginal means an additional unit. Marginal means an additional unit. Marginal means an additional unit, okay? Be it marginal propensity to consume, be it marginal utility, be it marginal revenue, anything. Wherever you find this word marginal, that means an additional unit of something. So when we say marginal propensity to consume is a concept which shows that if your income increases by a certain percentage or by a particular unit, okay? For example, if your income increases by 1,000 rupees, how much of that increase, yani how much of that particular 1,000 rupees you will spend on your consumption. This is the concept of marginal propensity to consume. Are you getting my point? MPC is a very important concept. Have you understood what is MPC? Marginal propensity to consume. How much percentage of change in income, not in income, of change in income. For example, you are earning 60,000. Now the income increases by 5,000. So the change is 5,000 only. So how much increase or how much percentage or proportion of that particular change, which is 5,000 in this case, are you spending on your consumption, is marginal propensity to consume. Okay, percentage of extra income that is spent, also known as induced consumption. Yes, it is also called as induced consumption. So there are two kinds of consumption there in this consumption function. First is autonomous consumption, small a, and then we have the B, small b, which is induced consumption. Autonomous consumption, not depending on the level of income. B, or induced consumption, depends upon the income. Depends upon the income. Okay. Now there is a feature about marginal propensity to consume. First, let's understand, marginal propensity to consume is the proportion of an increase in the income then that gets spent on consumption. Okay, this is what I explained to you. MPC varies by income level, so it is dependent on income, right? Then MPC is typically lower at higher incomes and vice versa. This is very important. MPC is lower at higher incomes. Lower at higher incomes and vice versa, and higher at lower income. Now why this is the case? Because you know what happens is, when you have a higher income bracket, the proportion which you spend, first of all let's try to understand, consumption is a very basic expenditure, okay? We all consume and we all have a certain expenditure, be your salary 50,000 or 60,000, whichever amount you are earning, but your consumption is something which is almost fixed, okay? You will not reduce your consumption of say rice from 2 bowls to half a bowl, okay? So it will always be similar, almost similar, okay? So what happens is, when you have a huge income bracket, the proportion which you spend out of that income gets reduced automatically. But when you have a small income bracket or smaller amount of income which you are earning, the proportion increases, although you might be spending less, but I am talking about the proportion, okay, the percentage. So if you have less income, you are left with less saving. So for example, if you are earning 30,000 a month, Okay, you are also spending 50% of your income. First case, so you are spending 15,000 per month on consumption expenditure. In the second case, someone who is earning say 60,000 a month, he or she is also spending 50% of her or his income on consumption expenditure, but the proportion then becomes 30,000, right? So basically proportion, or 30,000 is too much. Now for example, you want to spend only 10,000 on your consumption expenditure. You never know that spending 15,000 out of 30,000 and spending 10,000 out of 60,000 might be similar, or they might be buying the similar basket of goods for you, the consumption goods for you. Okay, so basically marginal propensity to consume has a tendency of lower MPC at higher incomes and higher MPC at lower incomes. This is what you have to, something which you have to remember. So the formula of MPC here is delta C by delta Y. Delta C by delta Y. C here is consumption expenditure, Y here is income, overall income. So how much the consumption expenditure will change by how much percentage or proportion when the income changes by a certain percentage or proportion, or how much units of consumption expenditure will change. Delta, as you all know, delta is a Greek word which we use for change. Okay, this triangle, it is delta. Delta, we call it delta. Delta means change. Delta means change. Okay, so how much consumption, unit of consumption will change when a particular unit of income increases. Is that clear? This is marginal propensity to consume. Is it clear to everyone? Yes or no? And this is consumption function. So consumption function is basically what consumption function is showing to you, that your consumption expenditure depends on your autonomous consumption, okay, which will consume whether you earn or not. Okay, so autonomous consumption plus your marginal propensity to consume, which then depends on your disposable income. So overall your consumption depends on your disposable income. If your disposable income increases, your consumption expenditure increases. Okay, disposable income, not income, disposable income, because you deduct the taxes which taxes and all which you have to pay out of the income. Okay, so then we have the theory of consumer behavior. Now since we have discussed about MPC and the consumption function, so we are ready to discuss about the theory of consumer behavior. It tries to determine how a consumer decides to spend his or her money through the utility analysis. So basically in theory of consumer behavior, we try to understand the consumer behavior. In consumer behavior, we try to understand the choices a consumer makes, okay, within the alternatives which are available to him or her. Okay, so we are about to study the theory of consumer behavior. Before it, there is a small concept of consumer surplus. Consumer surplus. Now what is this word surplus? Any idea? Surplus and deficit. Surplus means something extra, okay, extra than you need. Deficit is quantity which falls short of your need. Is that clear? Surplus means extra availability. Extra availability. What is consumer surplus? See, generally what happens is we end up paying the amount which we are not willing to pay to buy something. Okay, for example, if you go to a shop and you want to buy a good, and even if you bargain, even if you are good at bargaining, suppose you want this product in 200 rupees, but then the seller or the shopkeeper does not want to give you at 200 rupees. So he says or she says that okay, I'll charge 300 rupees. So 100 rupees is not consumer surplus, it's consumer deficit. There's not a particular term like that, but you are at loss. Okay, your willing price is less than the actual price. Actual price is 300 and your willing price, that is the price which you are willing to pay to buy that particular unit of a product, is less. So that is the opposite of consumer surplus. So what is consumer surplus? When your willing price is more than what you pay or what is the actual price of a product. For example, if you go to a shop and you have paid say 500 rupees, which is the actual price, okay, but you were able and willing to pay 1000 rupees as well. Let's consider this, okay, you were willing to pay 1000 rupees as well. So 1000 rupees were your willing price, but actually what you paid is 500 rupees, okay. So consumer surplus means willing price minus actual price, willing price minus actual price, which in this example comes out to be 500 rupees. Is that clear? So this concept was basically, firstly it was given by a French engineer and economist, Jules Dupuy, but it was popularized and later propounded by Alfred Marshall. Okay, we are very familiar with Alfred Marshall. So consumer surplus is an economic concept that measures the additional benefit consumers receive when they pay less for a product than what they were willing to pay. So when you actually pay less for the product than you are willing to pay, then this situation is called as consumer surplus. Okay, is that clear? Yes, all right. So this is very easy concept and you can relate it to day-to-day life, especially the girls out there. Girls are good at bargaining, if I am not wrong, okay. So we often bargain and then we get the consumer surplus, right. The actual price is say 300 and we say, oh, I'll pay only 100 rupees, right. So we get a consumer surplus, okay. So consumer surplus, willing price minus actual price. Willing price, which the consumer is willing to pay to buy that particular unit of a product. Actual price, price of a commodity at which it is to be sold in the market, the actual price of that particular unit of that particular product in the market. Okay, moving ahead. This is the same formula, willing price minus actual price, or it can be asked in this way as well. You can, they can give you demand price instead of willing price. So that would be same, okay. You need not get confused. Willing price or demand price minus actual price or market price, okay. Now the next topic which we will be dealing with is utility. Utility. Yesterday only I have discussed with you that utility or value is the want satisfying capacity of a good, right. If you consume a good and it satisfies you, for example in summers we all consume ice creams, so when you consume ice cream it gives you satisfaction, so that satisfaction is called as utility in economics. Okay, so we'll study in detail about utility, types of utility, how do we calculate utility, what are the formulas of total utility, marginal utility. These are very important for your examination. So first let's try and understand what utility is. Utility in simple word is want satisfying power of a good. Simply, any good which you consume or any service which you consume gives you certain satisfaction. So when we calculate the want satisfying capacity of a good, we call it utility. Okay, then utility analysis is a method of measuring the satisfaction of consumers which they get after consumption of a good or service. I have discussed with you the two kinds of utility in yesterday's class only, but then now we have proper definition of cardinal measurement and ordinal measurement. As I told you that there are two types of utilities. Okay, the first idea or the first set of idea says that utility or satisfaction which you get from a good can be measured. So that idea is cardinal utility or cardinal measurement of utility. Another set of idea or economists, they say that utility is something which is not practical to be expressed in numbers. Okay, you cannot express your satisfaction which you get from consumption of a good in numbers, although you can rank them in preferences that okay, I get this much utility from this product and this much utility from that product. Okay, so cardinal measurement advocates that utility can be measured in terms of numbers like 1, 2, 4, 6, 8. So they are basically saying that if I enjoy a chocolate cone or cornetto cone, it gives me say 8 utils of utility. Utils is the unit in you measure the utility. So it is not practical, okay. We do not say that eating a tub of ice cream, enjoying a tub of say coconut ice cream gives us 50 utils. Do we say that in our daily lives? No, right? Although we can say that okay, I enjoy this product, I like eating this product. Yes or no? Yes. So cardinal approach is not so practical, although ordinal approach is, okay. Ordinal approach and in cardinal approach, the unit of utility is utils. 2 utils, 6 utils, 4 utils, 8 utils, okay. Then we have ordinal measurement of utility. Ordinal utility says that utility cannot be measured in numerical units, although the rank can be given to it. Okay, a consumer can at his or her best rank the preferences, although that is also something very difficult, you know? But you can rank your preferences from sets of most preferred to less preferred bundles. Is that clear? This is utility and types of utility. Then comes a very important law in microeconomics, law of diminishing marginal utility, which we will be doing detail in the later classes. But let me tell you very quickly, what does law of DMU says? Diminishing marginal utility. See, this is very easy. You can relate it to your daily life. You do not, economics is that's why very interesting. You do not need to mug up. It is something which will live every day. Okay, tell me, any one of you, that when you start eating a food, when you are hungry, when you just start eating, when you are hungry, so the satisfaction which you get, whichever food you are enjoying, okay, is more. The satisfaction initially is more. Then, you know, when you are about, your stomach is about to get filled up, the satisfaction reduces. At the end, sometimes you are unable to eat the food. The satisfaction becomes negative, okay. If you eat extra food, it will not satisfy you, rather it will discomfort you. It will cause discomfort to you, okay. Yes or no? We all witness it a number of times in a day, right? So law of diminishing marginal utility says that with successive consumption of successive units of a particular commodity, the satisfaction which you get with each successive consumption or each successive unit, it reduces or it diminishes. So law of diminishing marginal utility states that as more and more standard units of a commodity are continuously consumed, you should consume them continuously, okay. We are not saying that you have eaten one banana 1 hour before and then after 2 hours you are eating another banana. No, in that case law of DMU or diminishing marginal utility would not apply. It says you are consuming the units continuously and in a rational order. First unit, second unit, third unit, okay. So when you are consuming standard units of commodity continuously, marginal utility derived from each successive unit, each extra unit of a food or a good which you consume goes on diminishing. It is also called fundamental law of satisfaction or fundamental psychological law. Why? Because it is applicable to every kind of a good and service. हिंदी में भी आप लोगों ने सुना होगा कि किसी भी चीज़ की लिमिट जब क्रॉस हो जाती है तो वो हार्मफुल होती है, राइट. हिंदी में हम सब ने घरों में कहावत सुनी है, राइट, है ना. सो लिसनिंग टू म्यूजिक ऑन रिपीटेडली, यस, म्यूजिक शुरू में जब आप सुनते हैं तो इट गिव्स यू प्लेजर, लेकिन जब बहुत देर तक 1 घंटा 2 घंटे अगर आपने हेडफोन्स लगाए तो फिर देन इट कॉजेज यू हेडेक, right. So that is something which applies on consumption of any good or any services. So it is universal law. So that's why it is also called as fundamental law of satisfaction or fundamental psychological law, because it is applicable in respect of all goods and services, okay. So this law of diminishing marginal utility was originally propounded by H.H. Gosson in 1854. Originally this concept was developed and it has its origin by H.H. Gosson in 1854. But you know, that's why it is also called as Gauss's first law of consumption, but it was later popularized and further developed by Alfred Marshall. So you remember this, that this concept of diminishing marginal utility was originally developed by H. Gaussin. That's why it is also called as Gauss's first law of consumption. But later on, the present state of diminishing marginal utility, or the present concept of diminishing marginal utility which we are dealing with, is developed by Alfred Marshall. Alfred Marshall. He has also given his own definition of law of diminishing marginal utility. He says, Marshall says that additional benefit which a person derives from a given increase in his stock of anything, it can be anything, and the consumption increases, the additional benefit diminishes with every increase in the stock that he already has. Simple, right? So basically, law of diminishing marginal utility says that be it any good or be it any services, the successive units or each extra unit which you consume gives you less of satisfaction. Initially what happens is marginal utility will increase. Initially marginal utility will increase, then peak will come and then it will start falling down, and sometime it becomes negative. When you do not get satisfaction from consumption of something, rather you get irritated, or rather the consumption of that particular good or service harms you. Okay. Now this law of diminishing marginal utility works on certain assumptions. Not only this law, in economics everything works on assumption, because you know, economy and economics is such a complex subject and a system that if we consider one thing to affect a particular phenomena, we have to assume that other things are remaining constant. Because if we want to analyze that, okay, if there is an increase in price of a good, say X, then what will be the demand of good X? But we also know that the demand of good X will also depend on the income of a consumer, on the taste of a consumer, on the wealth of the consumer. But we cannot analyze everything at single point of time, right? So we assume certain things to be constant. We assume certain things to be there when we are analyzing a law. Otherwise, the law won't work, right? So in law of diminishing marginal utility as well, we have certain assumptions. I'll be dealing with these assumptions in tomorrow's class. So we'll end up this class here only, and tomorrow I'll take up part 2 of this class in which we'll complete this topic. Okay. So any doubts, any questions, anyone? I hope it is clear, right? Types of goods, consumer behavior, consumer function. So consumer function, we have discussed that consumption depends on the disposable income, level of disposable income. Also on the autonomous consumption, there is two-way classification, autonomous consumption and the induced consumption. Okay. And then we have discussed about the utility, what utility is, what is cardinal, what is ordinal. All right. And then law of diminishing marginal utility. I'll insist you to remember the consumption function. Okay, this is very important. Consumption function. Okay, and then we have also discussed about the consumer surplus. So these are the topics. We'll continue tomorrow. I hope you got all these concepts. Yes or no? Okay, so I'll see you in the next class tomorrow. We'll end up today and then we'll continue the remaining part of it. Okay? All right. Thank you so much.